All right, friends. Hi. I'm really happy to see you all together here today. A very good evening once again. Sorry for the delay. First of all, thank you. Thank you for coming in on this webinar. Uh, I'm aware about the situation on health front, which we all are facing, whether in West Zone or North Zone or South. We all are in the same zone, and rather globally, Omicron has taken a toll. But to just start a positive note, a very dear friend of mine who is a doctor said that God has sent Omicron from the perspective that vaccines are not enough to reach out. So treat Omicron as a virus come vaccine and let it hit because it's not hitting hard any which ways. There's no worry. There are few days ahead. We will see really good times, and probably this is just a start to a great end. And that's where I believe we need to be all positive. And again, thank you for joining in today. Um, just as a thumb rule, we all are there in the chat box, and I was very happy to see people wishing each other and me as well. As a concept, please put in your queries, friends, and whichever you believe is relevant, on the topic that we are talking. Either the query will be on GST or will be on GST on pharma and FMCG sector. Uh, Also, please do put in your email ID next to your query. The only intent is that if at all I'm not able to resolve those queries immediately for whatever reasons, time or the complexity of the query, we will come back to you over an email and try to resolve it. And that's the intent. So you may put up your query and your email ID next to it, and we'll try to answer it as much as possible. Uh, Probably we will see how the session is going, but probably I will try to keep all the question answer round at the end. So I'm targeting to keep 10 minutes at the last for Q&A, and before that we would ensure that the slides are taken up. Uh, to start with, now directly hitting on the slides. First of all, the topic of the day is GST on pharma and FMCG sector. So I'm sure whoever is aware about these two sectors and whoever is aware about GST or aware about both would laugh on me if I say that I would like to capture the aspects in next 50 minutes. Because I think in 50 minutes one can only talk about it at a 30,000 feet. We cannot get into a deep situation because these sectors are as complex as one can think of. So my intent over next 50 minutes would be to run through to the most important aspects of these sectors from the GST perspective and try to enhance knowledge for all of us as much as possible. What we are covering is overview of the sectors and the key models. The reason why we are talking about this is Hi, sorry, yeah. The reason why we are doing this is very simple that GST is an indirect tax and indirect tax is a transaction levy. Uh, the transaction levy will not make any sense to you till the time you know the transaction and you know the business. So our first 5 to 7 minutes or maybe a little more would be on overview of the sectors and also the key models under which the sectors are working. So you will understand the flow of the transaction and then it will be a little more simpler for understanding the nitty-gritties around it on GST side. Then obviously we'll talk about key issues. I have highlighted some key issues which are relevant, which are known to the government as well as the industry, and hence it is classified as issues and not litigation. And then we are heading towards litigation discussion, which are key pointers to take away with us as far as the litigation is concerned. New focus is just talking about the PLI scheme for a minute, and that will be ending up the session today. I have my co-speaker Nikita Maheshwari. She is a pillar as far as this slide deck is concerned. So thanks, Nikita, for putting in all the time and effort and bringing all of us together today.
Thank you so much, Jigar.
Overview of sectors. Friends, India and this is only from India perspective. So I have tried to keep myself away from global phenomena, which would take another long hours to discuss. But from pharma perspective, if you want to see the India fact sheet, this is in front of you. It is called as pharmacy of the world, and there are reasons attached to it. It is not randomly said. The data speaks. The data says that we are the third largest pharmaceutical production country in volume, and 14th largest as far as the value is concerned.
Jigar, I'm sorry to interrupt, but I'm not sure whether the slides are visible to everybody.
All right.
Because
Friends, I would need you all to comment on the chat room if the slides are visible. If you can see, please let me know. Nikita, you can see the slide?
no, actually I cannot. So that's why I just wanted to check with the viewers if they can view the slides. Just maybe a yes or no would help.
Vignesh said visible. Okay, visible.
All right, yeah.
Thank you so much, Rahul, Shubham, Abhinay, Dheeraj, and all. Thank you so much. Thank you. All right. So we come back to the slide. Why it is called the pharmacy of the world is what we all know. But more importantly, if you see the chart, the pie chart, in 2016, we saw 24 billion expenditure happening from the government side. And not less than 5 years, which is 2020, the exact amount got doubled. Near doubled, $46 billion. And that is the spend which is happening. I'm sure you must be aware that it can't happen that, government is spending double the money on this. But there is reason attached to it is because India as a economy is seen as a very potential high economy for this sector where people are getting migrated. So earlier, the migration or the manufacturing was happening in India only from labor incentive country perspective. But now the reality is that it is happening more from many other perspectives, including the way the manufacturing is happening, the machines are there, the way the conducive environment has been created, at least attempted to create it, and hence, overall the Make in India scheme, etc., is all working well. But coming back to the pharma space, we see the size of the market also getting almost not even almost almost 3 times in less than 9 years now. So $42 billion market size, and then directly hitting to 120. And my belief is this also would be bare minimum. It could cross this in a very huge manner because we are at the cusp of the changed environment as far as the pharma sector is concerned. My next slide is again not talking on GST and overall sector wise, but I would like to throw this point because this is something which I've been talking to a few of my clients, and when we were at the pharma council meetings, etc., we realized that how the sector has been looked at, I would like to say one statement which I keep saying. I wouldn't quote unquote any person, but that person has really opened up my eyes as far as the sector is concerned. That person said that when the pharma council meets up and they talk to each other, the way they look at pharma sector is by 2030 to 35, in that 5-year span, the target of the pharma sector is the death will be coming by choice. So that is the gravity of the pharma sector where the work is going on. You see the biopharmaceutical innovation and research. I wouldn't be surprised if World War III, an unfortunate event happens in near future, is happening only through biowar. No ammunition, no missiles. It's only biowar which happens. Robotic surgeries are very common these days, at least in the foreign economy. In India soon, hopefully it will begin. But again, the intent is robotic surgeries will bring in complete success ratio coming up. So no chance or error that could have ever happened is what the attempt is. Precision medicine and customized medicine again is very much in the radar. Again, in the global economy, this has been picked up very heavily, where the medicines are made actually customized to you and your health and your requirements as per the patient's requirement. It's not a random medicine. So if we link this pharma sector to a technology sector, you would have heard about a packaged software and customized software. What we are living today is in a packaged software world, which is packaged pharma world. Where we will land up very soon is a customized software, which is customized medicines for all of us. That is where the real change will begin. Even we would have heard about predictive analysis. So today, whenever there is any pain or a requirement, we go to a doctor or a hospital, and that's all reactive in nature. Uh, Basis the theory of predictive analysis and the data which Pharma World is working on, it is very. I mean, the theory and the research says that they were very confident of awareness into the problems which may come to you, considering all the gene testing that they may be having. So the RNA, DNA testing, etc., which is happening. Even the deadliest of the deadliest viruses or diseases can be known to you before it hits you. So that's where the pharma world is going, friends, and that's where it is important for us to know that the nitty-gritties of this sector also would be very, very different than what we used to see in the VAT and excise regime. A very quick product life cycle, obvious it is, but research would happen first. I mean, I would bar COVID from this life cycle because of the need. It has skipped the guns, but research, then development, then production, then distribution, and then the sales. A very quick slide. I would move faster here, but what are the growth drivers for India and what are the growth inhibitors are also in front of you. Few of them are the drivers are climate of the country, very stable climate. We are able to handle all the climatal change, unlike economies where there are very heavy cold or very situation which are not conducive enough to produce or manufacture any goods. So the climate, the political stability, the accessibility in terms of connectivity in various countries, innovation and availability of resources. The inhibitors are the policies and frameworks, the stimulus, the tax policies again. So those are all, if you see government driven, I again believe that they are aware about it and they are working towards it. They can't be giving the stimulus packages randomly, and hence a gradual work is beginning on that zone. And I believe good days are near as far as the sector is concerned from government perspective as well. Hitting onto FMCG sector, again, this sector is too large to talk about, but trying to decode it in a very simple way, I would split that sector into food and beverage, healthcare, and household and personal care. Percentage split of the sector within India is 19, 31, and 50. My belief is that food and beverage sector would swap with household and personal care in near 5 years or 7 years. A huge shift is happening in this sector, and very soon we may see this sector also changing very dramatically. I'm hearing some sound. I'm so sorry. Yeah. Again, growth drivers and inhibitors, I would move little quickly here, but role of e-commerce is the biggest one in the FMCG sector. A fun fact, in COVID times, we all were in home. Last almost 2 years, we have seen work from home and on and off, and going out, not going out. But there are large players in the FMCG sector. Again, I would not name any, but you would be shocked to know that the sales turnover had doubled. As far as I mean, one of the industries very common is the apparel industry, and within apparel industry, again the e-commerce players, where the sales were doubled in these last 2 years. The only reason is again the e-commerce played a big role, and people sitting at home, they started spending, whilst not going out, and the outcome is known to you. So there were success stories coming within COVID world as well in this sector. Common features. Why have we picked up these two sectors together, friends? Is very simple, because they are somewhere they talk in same language as far as the supply chain is concerned. So they are present multi-state. They are having products which are MRP based. The marketing methodology is very, very similar, if not same. The supply chain management, which we will be talking in the next slide, which will bring in the business model to you, is again almost same. And the both are consumption based sectors. So if the higher the consumption, the sector goes on the higher side. Key models. This one slide would help. Again, I believe that you all would be aware about this, but it is important for us to brush through this sector. So assuming there is a manufacturer of a pharma pharmaceutical sector, what all relevant stakeholders would be there in his business? One, a raw material supplier. Either it could be he would be an importer where the raw materials come from outside India, or a raw material supplier within India. There could be a job worker where the raw material goes and the job worker works and gives back the drug or the medicine or whichever products they are working under. There could be contract manufacturer. When we say contract manufacturer, means there would be a manufacturer who would be having all the machinery in place, and they would be doing all the manufacturing on behalf of the main manufacturer, and hence they are called as contract manufacturer. And they then would give away the goods to the manufacturer. Then once the goods are manufactured, on the output side, there are various series of people involved. Earlier, before GST, there were two type of agents: consignment agent and CNF agents. And post GST implementation, we see majority of the agents are CNF agents. The major differentiating factor between the two was under the CNF agent model, the agent used to be registered as a company itself. And in the consignment agent model, the agent used to be registered on their own name. So the manufacturer used to sell those goods to the consignment agent, and consignment agent used to further sell it out. There would be a trading happening between them. Vis-a-vis the CNF agents are very simple, are actual intermediaries and agents involved, and they used to be registered on the manufacturer's name. After the CNF agents who used to handle all the clearing and forwarding activities, there is a stockist. And the obvious reasons is that today, if you need a paracetamol, down in the village, at the corner of a village, you will still get it. And you will get it only because of the reason the supply chain is very strong. The stockist will stock it and will give it to the wholesaler basis the requirement. And there is a series of stockists and the wholesalers across India who is working seamlessly to ensure that the supply is made appropriately. Finally, the retailer, all the shops that we see across and we purchase medicines are all fitting in the retailer zone. There's also one more important aspect or two more aspects in the business model that we need to know before we start talking on GST is a marketing company, which is a P2P model, and loan licensees. Marketing companies are those companies where you may be manufacturer, but it is marketed under the brand name of someone else. So ABC Pharma may be manufacturing because it may have the licenses or it may have the machinery or wherewithal to manufacture, but ultimately it is sold to the final consumer under the brand name of XYZ. That typically happens in this sector. The reason is of various licenses and procurement and the capabilities that companies are having, and also at the same time the brand value that they possess since so many years. Loan licensees again are the aspect which you all need to know is from the perspective of manufacturing drugs are very restricted, and not, when I say restricted, means are very regulated, and it has to be done in a manner which is very important as far as the hygiene is concerned. So licenses are obtained by a manufacturer or by license holders, and then they manufacture it for the pharma company. So these are called licensees, and when they loan their licenses, they call loan licensees, where they can license those, they can give, lease those licenses to the manufacturer, manufacture those drugs and on behalf of the manufacturer, and then the manufacturer can take it up and start trading into it. By knowing this, at least you all may be aware about the models which are there. Pre-GST and post-GST models are fine, but as we spoke about the CNF agent, consignment agent, and the entire model earlier, we used to see pharma and even FMCG being registered across locations in India. Now they have done away with this concept, and they have done a concept of mother warehouses, where they believe that if in a west zone a mother warehouse is there as a stockist or a warehouse or a wholesaler, then they can deliver and ensure that all the retailers are getting the relevant goods at the relevant time. Just-in-time delivery is also possible with them, but there is no requirement of getting registered across, because of the main reason is if you get registered as per the GST law, you will be required to pay GST for the stock transfer. And earlier, the transfers used to happen under Form F, and there was no sales tax or CST being enabled. Coming to important pointers from GST perspective, any questions on the business side that you all may be having, you may please put up on the chat room. We will pick it up a little later. And now we start moving on to the issues. Few issues which are relevant and is in front of you: classification of goods, discounts and incentive, expiry of goods, input tax credit on process loss, inverted duty, and anti-profiteering. I would directly start on the topic, considering the time being there. Classification of goods. So whilst the theory is in front of you, you may be aware that classification is a problem across industry. When I say is a problem, means it is very important for you to classify the goods appropriately, else the rate of tax wouldn't be correct. So whoever wishes to understand this issue more can go on Google, just open up a civic website, GST rate finder, and type probably bangles on it, and see what rates are coming up. You will see plastic bangles, you will see gold bangles, or imitation bangles, rubber bangles, etc., 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 and other bangles also. So imagine a situation where you see a 5-story shopping mall, and bangles are being sold in it, and you go there and purchase, and ultimately in the ERP, in the SAP system, those rates are tagged at 5-6%, 12%, or 18%. How on earth government authorities can validate that those bangles are correct bangles which are sold, and the rates are correct? So a recent work being discussed with the government, the DGGI unit, is where the classification is becoming a big challenge for them, because there are, let's say, 25,000 SKUs and 80 lakh line items sitting in 1 month of a huge pharmaceutical or a FMCG sector client. It's impossible to validate that. Sampling can be done, but to find it appropriately is very important. This is a classic problem in this sector. And not only this, we have also seen a few litigation already working on very well in this sector, which we will be taking in the next slide. But manner of packaging, what brand is to be used, what is the end use of the product, all will decide what actually classification one has to adopt. So if your company or your client is not focusing on this topic, mind you, in the assessments and audits, this is going to be picked up as a number 1 point. Nikita, this is a slide seen, so we will have to run the poll first, right?
Correct, right. So I'll just request Sumita to start the poll.
So friends, we have a poll on the classification point. We will just run the poll in 60 seconds. Just help us to give your answers, and then I will throw the results in front of you. Sumita, can you start the poll, please?
Okay, sir. We are just doing it.
The first question, guys, which may be coming in front of you, would be: how do you classify the alcohol-based sanitizers? Is it a disinfectant or is it a medicament? We are getting results. I think we should wait for 10 more seconds and then end the poll. Sumita, I have an option of ending the poll here. Would I be ending or you would be ending?
You can end it, sir.
Okay. I'll wait for 5 seconds more. I think I have the answers now. End poll. Will the results be seen by the participants? I don't think so. So friends, 72% of you all said it would be disinfectant, and 27 said medicament. I have one more poll for you. How best would you classify the Odomos cream? Repellent or medicament? Well, the current results are appearing that I'm talking to the advanced ruling authority itself. I have 85% repellent right now. Okay. 82% repellent and 17% as medicament. I have the last one. How best would you classify skincare, acne, face lotion, and powders, cosmetic or medicament? All right. So here I have last 5 seconds, friends. All right. Cosmetic 7. Okay. Here we go. All right. So cosmetic is 80, medicament is uh, 20. Here you go, the answers. And most of you all were right. But let us just go through this once. Alcohol-based sanitizers, it is a disinfectant as per the Wipro Enterprise and Advanced Ruling. There, it was discussed at length on what is a disinfectant and what is a medicament. And to fall under medicament as per the authority, it was important to have a therapeutic or a prophylactic properties, and means it should be intended to prevent any disease. And uh, the company Wipro actually had a submission done with them that if hair oil can be treated as a medicament, which is basically used to remove or prevent lice. Why can't a sanitizer be also be treated as medicament? I obviously I'm not telling you all why the classification discussions were happening. Is obviously because of the rate of medicament being at 12% and disinfectant at 18%. So that was the reason why the advanced ruling were questioned. Finally, they said that it is not a medicament; it is a disinfectant, and it is not intended to prevent any disease. Whilst the common concept of sanitizer is to prevent the virus of COVID, but the intention is different. The reality and the properties are different, and hence it is treated as disinfectant. Even similarly, in Odumus case, in fact, this was a Dabur case which went all the way to Supreme Court, which the company was protesting against Allahabad High Court, where they said that it was a medicament, and the final answer remained that it's a repellent and it's not a medicament. The last one is little more dicey, and I believe there will be huge litigation coming up in the skincare, acne, and face lotion. There again, if you see, the authorities said that it is necessary to consider the efficacy in treating or remedying an injury, ailment, or illness. Now, to be very honest, as a layman, if I have a skin allergy, and if I go to a doctor and put some cream or a powder or a medicine, it's actually an illness or a ailment that is happening. But according to them, it is purely on cosmetic. It cannot be treated as a disease or an illness, and hence it was always treated as a cosmetic in nature and not medicament. So now I hope you all understood the problem or the issue which I was highlighting, that the classification of goods is very, very important, because that forms the fundamental concept of how much rate one is charging and recovering and paying it to the government. And that's where the issue in this sector is, in my view, never ending. Discounts and incentive, a huge debate and other, a gray area, even as far as secondary discounts are concerned today. First, let me just explain what is the law, and then let's go ahead with the type of discounts that we have. The law is very simple, friends. Before the time of supply, if there is any discounts given, by a supplier, and it is recorded on the invoice, it is supposed to be deducted from the value of supply. This is forming part of Section 15(3). After the time of supply, if there are any discounts which are being formed, the law is again very clear that it will be deducted from the value of supply only if it is pre-agreed. and it is linked to the invoices which are raised by the supplier. So if it is pre-agreed between the supplier and recipient, then the very well discounts can be given and the value of supply will be reduced. But the turmoil comes in various sectors, but in FMCG and pharma very specifically because of the chain that they have, which we just discussed about the stockist, the wholesaler, the retailer, the manufacturer, etc. So the chain is very huge, and the discounts are often provided. So what we see in front of us is pre-sale discount, post-sale discount, subsidies mentioned, which are linked with the supply, are included in the value of supply if the supplier is receiving these subsidies. Free samples are given by the sector. I mean, I don't think so. Any one of us has not seen, whenever we are visiting any doctor, we see a box, a suitcase coming up by a person, and it has all the medicines, and those are the free samples provided by the manufacturers to the doctors, saying that these are the medicines which you should be promoting. Supplies by the recipient. So if there are counter supplies happening by the recipients in the sector, again, what is to be done? And combo packs is common aspect across, specifically in FMCG sector. So we will talk more about it in the next slide. 1 second. Yeah. So your friends, what is happening is there are various circulars which got issued on this this space of the discounts. One of the circular in 7th March 19 said that if it's a free sample, if you're providing, it's not a supply at all, and hence there should be no GST on it, which is fair. And obviously there is an input tax credit restriction coming up on it as per the 17(5)(h). Buy one get one free, again we would have seen very commonly being seen when we are going to any of the malls and buying soaps or detergents or whatever it could be. We always see this concept of buy one get one. So question again comes up in what is happening. Are they supplying one for free? Are they promoting? Are we supposed to reverse input tax credit, etc., etc.? The clarification says that it's a supply of 2 items but cost of 1. So in a way, there is no input tax credit restriction if you are having buy one get one free concept, which is very important because when GST came in and people were providing discounts and samples and free promotional data or goods, they all went into the buy one get one or buy two get one free concept because that was more beneficial to them from input tax rate perspective. Discounts is fine. Secondary discount is a concept which we all need to know. These are things which are running in the sector. So secondary discounts are a concept where one person is, let's say a manufacturer A is selling a medicine which has an MRP of 100 rupees to a wholesaler, or in their language, it's a distributor. A distributor is going to give it to a retailer at whatever value. So a manufacturer will give it to a distributor at 50 rupees. And distributor will give it to a retailer at 70, and retailer will have to give it to the consumer. Today also, if we see in almost all the shops, there are 10% discount, 15% discounts available to the final consumer as well. So that final 100 rupees MRP good is sold at 85 rupees by the retailer to the consumer. So 50, 70, 85. This is what it happens. Now, secondary discounts, for an example I can give, is where a retailer calls up a distributor and says that I would like to sell it at 85, but my competitor is selling at 80. You please pass on them some discount further to me because otherwise I will not be able to sell. So distributor will say, okay, no problem. I will not sell at 70, but I will sell it at 65 rupees. The already transaction is done, but goods are there with the retailer. That is the time when the discussions are happening. And distributor will say that I will sell it at 65, don't worry. So I will pass on 5 rupees benefit to you. You keep selling the goods because it's important for us to capture the market. Distributor goes back to the manufacturer and says that, this is kind of discount which I had to pass on. You had committed that you will give me a 20% margin or, probably 15% margin, whatever that data says. So you stick to your percentage and give me the benefit back. This is what typically a secondary discount is all about. So this is again post-supply discount. If you see, it is not pre-agreed. It is just agreed with the percentage between manufacturer and distributor. So whether GST benefit would come in here or not is what the question was. Government intent was it should not form part of the discount. And they issued a circular on 20th of June, which highly covered, saying that this is a type of consideration and there is no benefit which should be coming in of GST credit note on this. but the circular got withdrew on 3rd of October because of the representation being filed by the sector, and they said that the business is very complex and we can't be saying GST benefit is not available for the discounts that are being provided, because ultimately it's a business call, and a person cannot suffer on GST if finally it is not forming part of the transaction. So ultimately the circular has been withdrawn from 3rd of October retrospectively. But if you really ask me today, if a client calls up and says that I'm entering into a secondary discount model, I don't think so. Anyone can answer in a black and white. It is always a gray area unless the documentation are very clear and the mechanism is very clear, which in my view, documentation can get clear, but mechanisms in this sector will always be very, on the spot. It has to be evolving all the time. So the secondary discount is becoming a big challenge. I will run a poll, the next poll for 2 minutes on this matter, and then we see how do we go ahead. Okay, it's already running, is it?
Yes, it started. So we just maybe need to just tell the question.
Okay, the question is: distributor sell goods at discounted price, which is subsequently reimbursed by manufacturer. Will it be? Will credit note be available to be issued, or it is a credit note will not be issued? GST benefit can be achieved or not? So basically, the question is whether it will be treated as a consideration for the distributor, or it will be covered as a discount. Yes, I'm very happy to see the percentages coming up finally, unlike the earlier ones. I'll end the poll in next 5 to 7 seconds, friends. All right. 52% consideration, 47% is discount. Nikita, you'll run the next poll?
Yes, I'll do that, Jigar. Sure. The next poll, the question for the next poll is that the quantity discounts which are given by...
Okay, I started. Nobody. Yeah, go on.
So the next question, friends, is that quantity discounts which are given by way of providing free products or extra products, what will it be? Will it be individual supply of free goods, or will you call it 2 goods at the price of 1? Maybe for another 5 seconds, we'll run this.
Yeah.
So closing this poll.
15% as individual supply, 84% as 2 goods. You can run the next poll, Nika.
Yeah, will do. So the next poll, friends, is on an amount is being paid to authorized dealers towards rate differences and special discounts, which are not covered under the agreement. So these are outside the agreement. What will you call it? Will it be a consideration or will it be a discount? Ending the poll in another 5 seconds. So our poll says 53% people think it's consideration and 46% think it's discount.
Yep. So, friends, I think it is good to see the answers, because I wouldn't say that it is that simple. The matter, the agreement, all the situations will be very relevant for us to know. But in front of you all are the 3 cases where discounts and incentives are treated differently. Distributors selling goods at a discounted price and reimbursing from the manufacturer. The case said it's a consideration and benefit will not be achieved, because according to them, if payment is happening on behalf of the final customer by someone else, also should be part of consideration, and discount cannot be treated. I'm not saying this is my view, but this is what the case has said. Quantity discount by way of extra cigarettes. Again, 2 goods at one price. We talked about it. 1+1 offer or whatever it is, but ultimately this is not individual supply and hence no ITC restriction, which is a good news. Amount paid to authorized dealers, rate difference and special discount outside the agreement purview, very well covered under consideration, not a discount, because as I said, the law says it should be pre-agreed. Moving on to the next point, expiry or near expiry goods products. Again, conceptually, I will tell you all friends, and due to lack of time, I will run a little bit faster than what ideally this important topic would be, but let me try to capture with important aspects. One, expiry goods, obviously, the law says that you have to issue a credit note before end of next September. So you have broadly, if a supply is happening in the month of April, you have 18 months with you to issue a credit note. So today, if a supply is happening and because of the expiry of the goods are supposed to come back to you, you are supposed to issue a credit note. But the reality is, as per the current situation and the Drug and Cosmetic Act, the expired goods typically are beyond 18 months. So if you see any goods, even if a medicine is purchased, typically you will see an expiry happening after 2 years or even sometimes after 3 years. So what happens in that situation is those goods actually come back to the manufacturer and because it is expired, it cannot be reused, it cannot be scrapped, it cannot be sold, it has to be destroyed. And in that scenario, section 17(5)(h), which says that input tax credit claimed by the person who is destroying the goods needs to be reversed. Now that is the problem or the double jeopardy that we are talking about. So today, if I supply, let's say 100 rupees of goods, and tomorrow after 3 years, the goods are coming back to me, I am not eligible to raise a credit note. And at the same time, I destroy those goods because I am supposed to. And ultimately, because I'm destroying those goods, I'm supposed to reverse the credit which I claimed 3 years back. So that's what the concept of expired and near expiry products are. Government is also aware about it. But this is where the circular came up on 26th of October 18. I don't think so. The problem is resolved yet because the major challenge is not about issuing credit note or not issuing credit note, because if you see, they have very categorically mentioned in the circular that if you return expired goods after the time limit, you can issue a commercial credit note. What do you mean by commercial credit note? A credit note which does not have any GST element on it. So basically, goods can return on delivery challan, everything can happen as its own, but GST has nothing to do on it. And return of expired goods to be treated as fresh supply. In case there is a possibility, then a fresh supply will happen from the recipient to you, and they will raise an invoice. But mind you, the major aspect is, as per the Drug and Cosmetic Act, you are not eligible to raise an invoice on the goods which are expired. So I really wonder how this problem will be solved. But currently, the major challenge faced by the sector is if they are destroying those goods, are they eligible? Are they supposed to reverse the credit or not? Is something that they are grappling with. In my view, credit reversal should not be happen on the goods which are being destroyed, but reversal should only happen if it's a fresh supply and only to that value of the goods which are already expired. So if 100 rupee goods are expired, I believe the value of those goods are not even 5 rupees, and if that 5 rupees on which GST is supposed to be reversed, it has to be reversed in that zone. ITC and process laws, again, applicable on all industry, but this industry as well. We all have studied this in our good old days. There are normal laws, there are abnormal laws, and what happens if there is a loss, which is a normal loss in the manufacturing process? Are the manufacturers expected to reverse the credit? Because again, 17(5)(h) as a section says that if there is a loss, or the goods destroyed or written off or scrapped, you are supposed to reverse the credit, correct? So a very simple point, it was come up at a high court level where ARS Steel and Alloy Industrial Private Limited was there, and they, as an appellant, had come up with a very detailed submission that why a normal loss should not be considered as a loss akin to goods destroyed, scrapped or written off, and hence it should be there should be no reversal of ITC on this process. That's what it was pronounced as well. Inverted duty structure, if you are from pharma sector, if you are serving a client in the pharma sector, and if you're not aware about inverted duty structure, then we are not dealing appropriately, is what I would say. Because this sector is the biggest sector, amongst the biggest sector, which is hit by the inverted duty structure. I think other than footwear, the pharma is the biggest one, and the plastic probably are the biggest inverted duty structure hit sectors. Concept is very simple. If the output is chargeable at a lower percentage, and input or the cost of procurement of those or the cost of manufacturing those goods are at the higher rate, you are basically hit by an inverted duty structure, and because of which you will land up into accumulation of the credit. So this is a major problem in the sector because of the way the sector is. Either they are exempted under healthcare, or they are medicament, or they are drugs, etc., and at a lower rate of 5%. So you will end up, accumulating credit in a very big way. That's what we have seen, and that's what concept is. While the law says the refund of inverted duty structure is available, we are all aware about litigation happening on this front, and we have one slide which we will take up during the litigation space after this, which will highlight what is the problem in the inverted duty structure litigation. Anti-profiteering, again, a concept for this sector is very difficult to handle. Specifically in COVID times, we saw the rate of medicines, drugs, etc., changing left, right, center. For anti-profiteering, the concept is very simple. If you are having a change in the rate of tax, the benefit should be passed on to your customer. Now, to commensurate this benefit, it is important to know if the benefit is coming to you or not. And trust me, if I ask any of the client in pharma sector that whether because of anti-profiteering, what all you have passed on to your customer, the simple answer is they will laugh on me, because at the SKU level, at the unit level, at the product level, at the formulas level, it is impossible to detect the benefit coming to them. And whilst they have worked around it, we would have seen majority of the FMCG and the pharma space paying up huge anti-profiteering money to the government whenever there is an investigation happening. I reading again without name, the first very case on anti-profiteering happened almost 2.5 years back, where almost 130 crore rupees was deposited on consumer welfare fund by a FMCG giant. The only reason is basically that the investigation happened and they did their own calculation. My belief is the calculation is still very at the 30,000 feet, and one cannot get into so deep diving, because earlier the concept was this was only a transitional law. That was what was learned. But when we read the law and when we understood the concept, and in fact recently they got the NAPA, the authority which is National Anti-Profiteering Authority, got a further extension till 30th November 22. So this will stay with us, friends, anti-profiteering problem. And any rate changes which will happen, it is very important to see it from the magnifying glass and quantify the benefit so that it can be passed on and it cannot come up to us in future. Well, we head to the key litigation. Just to understand, Nikita, how much time do we have? 10 minutes or 15?
So, including Q&A, I think we are supposed to wrap up by 6:15.
Okay, 20 minutes I have. So let me run this by 10 to 15 minutes, and then we'll have 5 minutes of Q&A. Friends, you can pour in your questions. I'm seeing some questions already, but you may please put in as much as possible and we'll move ahead. I have 4 to 5 case laws which I wanted to talk. It will help in to learn about the nitty-gritties on the sector further. One, Sanofi India, Maharashtra AAAR ruling. Here the company was giving diaries and watches and foreign trips, etc., to the distributors for free, and they obviously had their branding done on all these goods given to them. And this is a very common phenomenon done by everyone. Branding done, and the goods are given during a festive season or for whatever reasons, a New Year concept probably. And the intent is very simple: to remind the distributors about the product, about the relationship, and ensure that the promotion happens. The question before the Advanced Ruling Authority was very simple, whether ITC is available to them or not, because it's provided free of cost, or ITC is not available. You will be shocked by what happened. So first, obviously, the answer came in ITC is not available, and it moved further to the AAAR. But you will learn this. What happened at the AAAR concept is there were two members, obviously, as per the law, CGST and SGST member. The CGST member said that ITC should be available, and it should be available because actually it is done for the furtherance of the business. If you apply logics, I agree with that member, and with due respect, I understand that whatever is done as a furtherance of business, the credit should be made available to the businesses. While the SGST member said again that it's a free gift, and the restriction would bring in. Here, there are very few cases where we have seen this kind of concept where there is divergent views of AAAR authority, and hence 1013 section got applied there, where it was very clear that if the members are having divergent views, then the advanced ruling would not be issued. There will be no ruling on it. So, we see the entire journey of AR coming up and then AAAR, but the end result is that today they don't have a ruling in place whether it is available or not available to them. I'm assuming conservatively they would have not claimed, or companies are not claiming, but it can be seen that this litigation will not be ending up here. Once the tribunal is formed and once the matters come up, we will realize that the sector has claimed credit, if at all they are in that zone of aggression, and we will see litigation coming up in this zone very heavily. About healthcare, next case, friends, here a very classic example is there, and I would try to explain it. Abbott as a company provided free medical instruments to hospitals. Let's say a random example. Let's say beds, hospital beds. So as a company, they gave hospitals some instruments to not beds. I will say instrument only because I stick to the facts. And they gave instruments free of cost. There was no consideration to it, but there was a condition attached to it that they will be the hospitals will be purchasing medicines, disposables, consumables, reagents, etc. from the distributors of Abbott. So there is a conditional goods supplied or instruments supplied by a company so that the goods are ultimately sold. And I don't see any wrong thing in this, because I think if they wish as a company to provide something free of cost as an instrument, they should be very well doing it. And in return, it is not wrong to expect that if the situation comes in, they may see the goods being sold to those hospitals. But the question here was whether such kind of supply should be taxable, whether should be considered supply or not. The fourth bullet in front of you is the sequence which they had to follow. They had applied for an advanced ruling. They got a negative ruling. They went to AAAR. They got a negative ruling. They went to High Court. They again got a ruling, and it got remanded back to AAR, saying the High Court said that the AR did not see things properly. It has to be remanded back. And again today means very recently they got another negative ruling back, from AAR. Nikita, what do you say for this? You have a term for this, right?
So I would say that Lot ke buddhu ghar ko aaye.
Yeah, so AR, AAAR, High Court, again negative AR. So they are there where they were, and they are facing the problem. So AAR has put up a view that it is liable to tax. It is a supply, because of one reason is that they are not only providing free of cost instruments, but also putting a condition that if the other goods are not purchased from a distributor, there will be a deficit amount being charged. While they have not charged because the distributors got the business from the hospitals, but they said that if that situation would have arisen, then probably this is a consideration only, because definition says whether in money or otherwise, and for the inducement of the supply. So they have captured this, and they have said that it's a supply in itself. But realistically, again, the main problem comes in what is the value of those instruments that they will consider. Again, the AR is silent on it, and I believe again a great litigation is on our way within the GST regime, that if supplies like these are happening by giants like Abbott and others, I wonder how things will form in place, because if there is no condition in the agreement, then probably it is good. But as a business runs, I believe conditions will be there across the industry, and that is where the realignment of agreements are supposed to be done to make it very amplified and cleared. Third, Sterling Biotech. Here, again, a very classic case. They are into supply of bulk drugs, and the question before the Gujarat Advanced Authority was whether a reduced rate of 5%, which covers under notification 1/17, whether that will be eligible for them or not, which is basically giving benefit of 5% to drugs. Now, going deep down by the Advanced Authority, they said, the authority said that if you are providing bulk drugs which are supposed to be provided to manufacture those medicines, while the drug definition, which is very much not there, neither bulk drug is defined, neither drug is defined in the GST Act, obviously, but you have to borrow from Drug and Cosmetic Act, and from there, if you see, the drug is defined that it is to be used by the human beings, and bulk drug is is defined as used for as an ingredient in any formula. So, because of these differentiating definition, bulk drug cannot be considered as a drug. Here, a very classic case again, applicable across India. Everyone would have seen it and feel it, but we would have not understood the nitty-gritties. The question before the Karnataka Advanced Ruling Authority was when a hospital is providing services, a healthcare service, how do we treat the input tax credit? Whether when the medicines are given to patients which are in hospital, and they are provided hospital services which include surgeries or which include operations, and medicines are being used, whether credit is available to them or not on those medicines. If those medicines are used for patients which are outpatients, not inpatients, basically which are not admitted. Third is if medicines are given over the counter by the hospital, because every hospital typically has a pharmacy or a pharma lab around it. And last is if supply of food and beverages are done within the hospital, again, what do we do as far as the credit is concerned? I believe the questions of credit is mainly, the reason why they were asking is to understand whether the output is exempted or not. If output is exempted, automatically credit is restricted. If output is not exempted, automatically credit is eligible. That was the key reason why the questions were asked. The answers which the Karnataka Authority has spelled out, they said that if medicines are given to inpatients which are admitted to the hospital, it is a part of a composite supply. It is not a separate supply, and hence it becomes a healthcare service exempt from tax, no ITC available. If it is given to outpatient, the medicines are a part of treatment, and hence again it becomes exempt. So they are not differentiating any inpatients or outpatients, admitted or non-admitted patients. If they are given, it is consumed during the activity of operation or surgery or whatever, or even a routine checkup. But if medicines are given, it is supposed to be considered a healthcare, and hence exemption, and hence no ITC. Over-the-counter medicine sales are liable to GST, and hence ITC is available. And patients are not allowed to have outside food, and hence again the food supply and the beverages supply which are done to the patients, it is very well a composite supply forming part of the healthcare service. No ITC is available. So if you see, in my understanding, various hospitals are having different views and different positions are taken. If we see a journey of litigation coming up only on this point, I will see a minimum 1,000 notices coming up only in West Zone, by the government, and they will see how litigation will begin on this space, which right now is just sitting on as a minesweeper game. Again, various views are there. I wouldn't want to ambush myself on this. What are my views and what are the industry views? But you may realize that a definition of composite supply, a definition of supply, definition of separate supply, all is important for them to understand because ultimately it's a healthcare service or not is very important. And obviously it carries out further also. For example, this case has said that for the food and beverages, it's a bundle supply, no GST on it. But what happens to the food and beverages which are given to the person who is accompanying the patient in the room? And typically one person accompanies the patient in the room, and he's also being provided food and beverages. Are they supply? Are they exempt supply? No ITC. I think God has to come down soon to, and take on avatar again to understand these nitty-gritties and give us answers. But that's where we are heading. I think this is the last case. I told you about the inverted duty structure case. It has gone to all the way to Supreme Court. The problem, your friends, was that inverted duty structure refund is very well available under the law, under Section 59 and read with Rule 89.5. But the law very clearly said, or rather I will say not very clearly said earlier, but now it very clearly says that the credit is, the refund is available only on the inputs. So as far as the input tax credit is concerned, there are three verticals: input service, and capital goods. So what the law says is inverted duty structure is understood, but only with regard to input, which is there for providing the output services. If that is going to create the inverted duty structure, that is the only refund which is available to you. A classic example I'll give you. Let's say I am providing drugs at 5%, and I'm having my office on which I pay lease rentals, on which 18% is paid. I pay to my auditors, I pay to professional legal firms, and there are other services which I use. And I also obviously have raw material inputs which are at 12%. So what government is saying is they will be only treating that 12% of input which I am having for the inverted duty structure against the 5% of output. The balance 18% of credit which is sitting on my head, which is unutilized, I am not eligible to claim the refund. Various high courts have pronounced negative and positive judgments, but finally a Supreme Court case on VKC footsteps have come, which says that the intent of the law is not to make it eligible. They very well also acknowledged that if you see quoted unquoted, it says, accordingly we shall refrain from replacing the wisdom of the legislature or the lawmaker. However, given the anomalies pointed out by the assessee, we strongly urge the council to reconsider the formula and take a policy decision regarding the same. So there is an anomaly, it continues to be there, but if you are into the sectors where inverted duty structure is there, as per today, refund of input services and capital goods are not available to you because of the Supreme Court landmark judgment. Unless there is a further change in the law or something comes up on this, I believe it is a dead end for now. Last slide, friends, is on the PLI scheme. I wanted to end again with a high note, saying that government is looking after the scheme, after the sector very closely. They have issued a production linked incentive scheme for certain sectors. One of the sector is pharma, and there are various categories in it. There are more than huge amount of incentive being planned on this, and if I'm aware well, many have already applied on this scheme. Again, the concept is running towards the Atmanirbhar Bharat and manufacturing of pharmacy in the most possible manner within India. So that's where my slide ends. I have 5 more minutes, friends, to run the questions. I would check with Taxman. Komal, are you there?
Yes, sir. Please tell me.
Okay. Anything else to add? Otherwise, we can go to Q&A.
Yes, sir. You can proceed with the question answers.
All right. Nikita, have you seen any questions till now?
Yes. So I'll just maybe pose the questions to you.
Yeah.
So Mr. Aditya Umarji has asked, will stock differences during physical audits be treated as normal losses, or will they be treated as abnormal, and whether ITC reversal is required? Stock differences during physical audits.
My belief, again, Aditya, would be this would not be normal loss, because stock difference losses and during audits, and specifically in a country like India where the fake invoicing and concepts of theft, etc., is very high. My belief is this wouldn't be considered as normal and reversal would be triggered. But again, there is no precedent in my mind right now. My view today would be reversal would be triggered.
All right. Next question is from Mr. Sudeep Bhagat. He asks whether recipient of the secondary discount would have to discharge GST, as it may be shown in P&L account as discount received. Department is taking this view, and the seller has passed on the discount by way of financial credit note. So this is a question on secondary discount. So whether the recipient would have to discharge GST on any secondary discounts received.
Yes. So Sudeep, very well, agreeable point. This is a problem. So the government, unfortunately, is not looking out from the same lens. When they're looking at a supplier, they are saying that this is not a discount available to you, and hence issue a commercial credit note. But when they're looking at a recipient, and if that recipient is in a different state, and a state government is coming up to look at the assessment, then they are not looking at it as a commercial credit note. They are saying that it's a supply, a fresh supply from you, for which you have recovered this money, and you are supposed to raise a debit note or an invoice on which GST is liable to be charged. So I agree with you. This is the view. In my view, it has to be same. If it is a commercial credit note eligible to be issued by a supplier, it has to be outside the GST lens for the recipient as well. But unfortunately, that is not happening.
So maybe with one last question that we can take, looking at the time. Manufacturer. So this question is by Mr. Hiren Pathak. He asks whether manufactured goods sold to stockists supply these goods to dealers. Now the company wants to give turnover discount to dealer, to whom the company has actually not sold goods directly. Can the company issue a GST credit note to the stockist, and then he can in turn issue a credit note to the dealer? So he's talking about back-to-back credit notes.
Sorry, I was not able to follow, Nikita. Would you like to answer, because I was not able to follow it?
Yeah, so Jigar is asking, there are three parties involved. One is manufacturer, next is stockist, and next is dealer.
Yeah.
Manufacturer wants to give some turnover discount to the dealer, who's third in chain. But manufacturer has not sold the goods originally to the dealer. So how can that discount be passed to dealer?
So no, you're right, Hiren. In this view, in this example, idealistically, a credit note cannot be issued. Section 34 does not allow you to issue a credit note. The dealer will have to raise an invoice on the manufacturer for the benefit that they want to take, and that is the credit which even the manufacturer would be eligible to claim.
Yes, I think Jigar, that would be all. Or would you like to take one more question?
I'm okay with one more question.
Yeah, so this is again from Mr. Aditya Umarji. Multi-state presence enterprises face a typical problem of credit accumulation. Can stock be transferred at valuation using deductive value method as per customs valuation rules?
Well, it can be done. Yes, go ahead, Nikita.
No. So he's asking about deductive value as per customs valuation.
Again, Aditya, there is nothing under the GST law in my mind which defines this. In fact, if it's a stock transfer and the recipient is fully taking a credit, and if it is under the same PAN, you would have seen the law which says that the value wouldn't be disputed. It can be done at any value. So in my view, in your example, it is the same PAN and ITC is available. It can be done at any value. So deductive value method, if you're applying, I have no reason to believe that it could be a litigation point.
Sure. I think that's all.
Just one thing I would request. I was just seeing the Q&A. I can see at least 10 to 15 more questions. So friends, just one help. As I said in the starting, if you can put your email IDs on the comment box itself, we will try to pick up your questions and reply to you over an email, so that you can have your answers with you and benefit from this overall webinar. So if you can put in the email ID, we will reply to you. Else, my numbers are there in front of you. My email ID is there in front of you. You may reach out to us for any assistance on this front. Thank you so much. Komal, back to you.
Thank you, Mr. Jigar, and thank you, Nikita, for this insightful presentation. I believe this will definitely benefit our audience. We appreciate the time you took to prepare the subject matter for this webinar and precisely explained it to our audience. I also thank the participants for being so cooperative and taking time of their busy schedule and joining us in this session to make it a success. Though Mr. Jigar has tried to reply to most of the queries raised during this session, yet in case you have any further questions, you can also send them to us in writing at sales@tachman.com. We shall fetch the answers and reply back to you. Thank you all once again. We shall soon be back with another vital topic. Till then, keep safe. Have a great time. Bye.
Thank you.
Thank you, Komal.